Welcome back to our discussion of monetary policy and money in particular. And where we left off is we're going to be talking about how we could categorize different types of money into different categories. And the categories are based upon liquidity. In the last video, we talked about liquidity. Liquidity is how quickly an asset can be turned into goods and services. And what we're going to do is we're going to have three classifications. Well, basically two classifications. The first classification is going to be the most liquid form of money. In other words, this is the type of money that could be most easily converted into goods and services. And the second classification is going to be a form of money that's less liquid. And so that first form is what we call M1. M1 has several different types of money in that classification. And each one of those types of money in that classification is considered to be very liquid. And what do we have here? Well, we have cash and transaction accounts. And the other thing that you don't see is traveler's checks. Traveler's checks. And so M1 includes currency in circulation, transaction account balances, and traveler's checks. Now, transaction accounts, that's another fancy term for checking accounts. Now, the distinguishing feature of a transaction account is that they permit direct payment by a third party by check or debit card. Now, some people say, well, the only reason why I have a positive balance in my checking account is I put cash or deposited cash into my bank. Well, if you deposit cash into your bank, that cash, the cash in circulation is part of, or the cash held by the public is part of M1. When you deposit it into your bank, it's no longer held by the public, but it's now in the form of a checking account. And so there's no change in the money supply in that regard. But what we're going to discover is our banks can actually create checking accounts out of thin air. So if checking accounts are considered to be money and banks can create checking accounts, therefore banks can create money. And we'll soon discuss the interesting fact that banks are the primary creator of money in the U.S. economy. Now, M2 is a less liquid form of, it's a less liquid classification of money. Now, M2 includes M1 plus some other less liquid forms of money. And they include savings accounts, money market mutual funds, a CD accounts. CD stands for Certificate of Deposit. These are less liquid forms of money. And for the United States, in essence, the money supply is considered to be M2. Now, we used to have something called M3, but M3 was no longer totaled in about 2006 by the Federal Reserve. So in other words, the United States dropped the M3 classification. Therefore, the money supply for the United States in essence is M2. Now, one important fact, this is an important fact here, how much money available to the economy will affect consumers' ability to purchase. Therefore, it affects aggregate demand. If we limit the money supply, we limit the medium of exchange, and it's more difficult to make transactions, so less transactions take place, therefore there's less demand. Now, like I said before, until recently there was a third classification of money. It's called M3. But on March 23rd, 2006, the Board of Governors, which is the federal oversight component of the Federal Reserve, which is our nation's central bank, and we're going to be discussing that in the next chapter, stopped publishing totals for M3. And according to the Fed, M3 did not appear to convey any more information about economic activity, so it said, hey, let's go with M2. So M2 is considered to be our money supply. Now let's look at this visually. Now remember, let's look at both. Let's look at currency in circulation. So as of February 2018, there was $1.5 trillion of currency in circulation. So that's part of, right here we have M1 right here, and here we're going to have M2. Now remember, M2 is M1 plus some other less liquid forms of money. So what we're doing is we're tallying both. So currency is in both M1 and M2. The other part of M1 are transaction accounts, and that's about $2 trillion. And of course, that's also part of M2. And then traveler's checks is a very small portion of the money supply, only $1.9 billion. Now, this, and this totals M1. And so M1 was about $3.6 trillion in 2018. Now M2 is M1 plus, so that's M1 plus savings accounts, and that was a whopping $9 trillion. And then money market, mutual funds, and time deposits. Time deposits are certificates of deposits, sometimes called CDs, and that's about 1.1 trillion. So that totals M2, which was about $13.8, $13.9 trillion. That's the U.S. money supply. Now take a look at this. Don't you find something interesting? The largest component are savings account balances. So when you combine savings account balances, transaction accounts, and time deposits, banks are in charge of creating those things. So the largest portion of our money supply is created by banks. The currency, look at this. Currency in circulation is roughly only about, what, 10% of the overall money supply. This comes as a shock to some people. Most people think of the money supply as cash or coin. But in reality, it is a small fraction. So I just told you in the last video that the money supply affects aggregate demand. And so we just established that banks are the primary creator of money. So therefore, banks have a big role to play in terms of affecting aggregate demand. So this is M2's growth over time. Now it makes sense that the money supply grows over time because the economy is growing over time. And by the way, these shaded areas, again, these are periods of recession. So the economy is contracting during these time periods. This is the dot-com bubble bursting in 2001, and this is the financial crisis in 2008, 2009 over here. Now, let me get rid of my lines here to make this a little. What you see here is, do you see this little blip? Oh, sorry. Go away. Do you see this little increase here? This was what we call quantitative easing. This is the Federal Reserve printing a lot of money to try to increase aggregate demand. They were trying to really lower the interest rate and get people to borrow money. And then they had another quantitative easing called QE2, and that was right here. And you can see the sudden acceleration of the money supply. Now let's go over how banks actually create money. And we're going to look at, so when a bank lends somebody money, it simply credits that individual's bank account. Now this is very important. You got to follow this point. When a bank loans someone money, in many instances, the money that they loan somebody is simply redeposited back into the bank. For example, I took out an auto loan many moons ago, and I went to my credit union, and my credit union gave me a line of credit or a loan of $20,000. And they said, okay, go out and find a car, and you could use this loan to pay for it. Now, of course, they didn't give me $20,000 in cash. What they did is they opened an account for me and deposited that $20,000, and I could write a check against it when I need it. Do you see what has happened? The credit union loaned me money. But before I got access to that money, they created an account for me. So in other words, it's like I redeposited that loan back into the bank. Now this lending and redepositing is how banks create money. And I'm going to give you an example of that. So when a bank makes a loan, it effectively creates money because transaction account and balances, checking accounts, are counted as part of the money supply. Now, let's take a look at an example here. So, because banks play such a critical role in the economy by creating money, bank deposit creation by banks is regulated by the government. And that government agency is the Federal Reserve. Let's go over a simple example. Assume a student deposits $100 of cash from his piggy bank into a bank. We call this monopoly bank because there's only one bank. And he receives a new checking account as a result. Monopoly Bank loans that $100 to campus radio station, and by crediting its checking account. So in other words, it could loan the money that was deposited to another party. Now when that party, campus radio, takes out a loan, they don't get access to that $100 right away. What happens is that loan is deposited back into the bank. And then in essence, money has been created. Now we could examine this process using a T account. And that's what I'm going to do in the next video. In the next video, I'm going to show you this process using a balance sheet.